The CCRC market is kind of coming out of its doldrums of the Great Recession. And so I'm sitting here with Dan Hermann. He's a Senior Managing Director and Head of Investment Banking at Ziegler, who has probably underwritten more, I would say, more CCRC projects than anyone in the country. And you know, with the collapse of the housing market, it was a bit of a rocky road for some CCRCs, especially some that were still in the fill-up or that were just opening up when the recession hit. How much better or more stable is the CCRC market today?
Steve, it's much more stable today than it was in 2008. By a large factor, folks have been working very, very hard to fill up around the country. There's a number of high-quality marketing firms in the sector, and many of our clients have reached out to those folks, or if they happen to be multi-facility systems, they might have a pretty deep marketing department, and they've been using a number of tactics, marketing tactics, sales tactics, sales training efforts to put themselves in a position to market to today's senior. A lot of programs around home sales and home staging to facilitate the senior moving in. So we've seen average occupancy continue to grow around the country. But there's no question there were a number that were in a very challenged state coming out of the 2008-2009 financial crisis.
And you know, some bond investors back then took some sizable losses on some defaulted projects, but we've seen in the last 12-18 months, we've seen a lot of new developments on the not-for-profit side of the CCRC market, some in the $100 million or more area. Is all forgotten with the bond investors in terms of 4 years ago?
No, not all is forgotten. It's clearly a lesson learned, but the sector had been very rewarding for the high-yield investor, both institutional and retail, for years, recognizing they could buy the debt of quality not-for-profit organizations that were in the senior living space, both CCRC and otherwise. These organizations range from large multi-facility systems down to single-site organizations. There were a handful or a number of defaults in the sector. Some of those were unenhanced bonds, and some of those were LOC-backed bonds. And investors understand what caused those. They looked and reported back to us or asked us correct or try and adjust your underwriting to address that, and a lot of it has to do with liquidity to get through longer fills, and we've done that. And when they looked at their overall portfolios, they generally fared well from a long-run perspective. And in the high-yield market, the high-yield mutual funds have anywhere from 5 to 20%, usually around 10% for the typical high-yield fund in the not-for-profit senior living space. And relative to other high-yield spaces, it's actually performed overall very well. Most own multiple names, so while they didn't appreciate the defaults, the recovery rates have been reasonable, although some were poor, and blended together with everything they owned in the portfolio, they would tell you our senior living portfolio actually performed relatively well compared to other high-yield spaces, which include land deals, which didn't perform well at all, the healthcare sector, tobacco bonds, and so on.
So that's why they're coming back into the market. As the CCRC market starts ramping up again, they're like, hey, it wasn't as bad as it seemed.
It wasn't as bad, and the merits of the quality providers. So there definitely was a lot of news around certain defaults, no question about that. There's numerous quality providers that have performed very well, and a typical investor, again, might have 15, 20, 25, 50, 75 different names in their portfolio, and the majority of those have performed well and rewarded them in their high-yield funds.
And some of these new projects, I mean, the bond amounts are $500,000, $600,000 per unit. What happens if we have another big shock to the economy? Another major housing market deterrent if we have the decade of Japan this decade? Right.
We've post-crisis, we use that phrase a lot. So coming out of spring of 2009, the question was, what modifications to the underwriting of new campuses, so singles or isolated new campuses, whether it was a multi-facility provider or a new single site. Although let me say that prior to the crisis, the vast majority of developments were by existing sponsors, but then you had some religious orders, some universities, some hospitals, but the vast majority were existing senior living providers. Post-crisis, it's essentially all existing senior living providers growing going forward. So that's one of the modifications that you're generally going to see. It's going to be the existing providers deciding to grow. Secondly, the recognition was we need that collectively, the sponsors, the developers, the underwriters said we need more liquidity to allow for a longer fill period. If you look at the average fill periods, it had been 24 months. That allowed room for a short recession, but not a one-year recession. If you look at the new campuses that have been financed post-crisis, the average fill period is 36 months. Mm-hmm. And that's basically budgeting for a recession or planning for it because they're also 70 to 75% pre-sold. And if you follow the old fill patterns of 24 months, you'd have substantial liquidity left over from planning for a 36-month fill. In addition, additional working capital has been set aside, and then the operating reserve fund, which is meant to be an additional reserve, was expanded, and the replenishment features on that operating reserve fund were expanded. So in the stress testing that we did at Ziegler, these new campuses could literally afford a 5-year fill without even tapping the operating reserve fund. And in addition to that, there's a market and underwriting requirement of a liquidity support feature from these sponsors backstopping the working capital fund, the operating reserve fund, to provide that worst case liquidity in the event of a recession. And those liquidity reserves have ranged from $3 to $10 million. On a typical $100 million issue that you mentioned, it would typically be about $5 million. And that's being put up by the sponsor and held into account or set aside on their balance sheet in a special reserve.
So much more conservative structure, which is good. Now, when CCRCs work, they really work.
That's right.
They really work. They're really popular. You know, and during the Great Recession, you know, even some of the good ones stayed at 95% plus occupancy,
right.
which surprised a lot of people. What makes for a new development? What makes for a good or successful CCRC in today's market?
It's what everyone wants in any type of good development, any type of real estate development, a great location in a good market. So you're able to get positioned where there's adequate to a substantial number of age and income qualified seniors. And so finding a parcel that fits that is difficult. Some really successful ones have been replacements of old hospitals in first and second ring suburbs where it's logical to zone them for senior living. Those have really done well. But then let me back up to the sponsor. Having a high quality, committed, not-for-profit sponsor is the #1 attribute of the good projects that understand the business, that want to be in the business, and that are committed to seeing the project through with either if they're developing it themselves or with their various development advisors and partners. Then you add in the good market, and then the underwriting structure that allows for the liquidity to see through an extended fill, in fact, if we have a recession. Mm-hmm. And as you said, most CCRCs have filled, if you study them in history, and in fact the average before the crisis was 94 to 95%. That meant half of those were above 95%. Today the average in the country, especially if you focus on the not-for-profit providers, is about 90%. They've offset that 5% drop, and it had been a 7% drop, so they've made up about 20 to 30% of the lost ILU occupancy, but they also made up the revenues on the healthcare side. So the good CCRCs today also have vibrant, when I say healthcare businesses that include nursing, assisted living, memory support, possibly even some home and community-based businesses or services, and they've generated meaningful additional revenue from that to offset the drop in the independent living revenue. Right. So if we measure by ratings, the average bond rating has not dropped. There's been an equal number of upgrades to downgrades since the crisis. In fact, here's a stat you and I haven't talked about. Of the 1,900 CCRCs in the country, about 1,500 are not-for-profit. Many of those are in multi-facility systems. There's about 150 rated senior living organizations. Not all of those are CCRC. But when you do the math for how many CCRCs are within a system that's got rated debt, plus the single site rated CCRCs, about 400 of the 1,500 have a bond rating. So we're up to over 25% that where their debt is rated.
All right. Well, that's not bad. So a lot of people have been critical of the not-for-profit model, myself included, of not having enough equity. So basically, you're saying with how you are now structuring these deals, with the liquidity support agreements and everything else, basically, the need to have that kind of equity, cash equity backstop is, I don't want to say gone, but it's been significantly mitigated.
Correct. And prior to the crisis, the model has been premised around pre-selling to 70. The range has been 65 to 75% for 30 years, with 70 as the midpoint. Executing properly on construction, on time and on budget, and that came under strain in the 05 to 07 period in the United States, where a handful of these projects actually went over their contingencies for a number of different reasons. But assume that a lot of time and effort gets put into executing on time and on budget, then the intent is to fill ahead of plan, collect entry fees, and pay down temporary debt, leaving the asset with permanent debt that's somewhere between 40 and 75% of debt to asset value. Clearly, you still have your entry fee liability. So the model's premised on staying full. That model has worked for years, assuming you have adequate liquidity to fill in a backstop if fill-up goes longer than expected. And today's backstops are essentially belt suspended and bootstrapped to literally allow for up to a 7-year fill. And both we on our end did stress testing, feasibility consultants did stress testing, developer, sponsor, and the investors. We have a number of investors that asked for special sensitivity analyses to look at different slow fills if we had a different recession, or if we had another recession.
And 2010 was probably not a great year for the bond market. 2011, you started seeing a lot more activity. I've been seeing a lot more, does 2012, did you outpace 2011?
Absolutely, because the long-term interest rate market is excellent right now. So the market has tailwinds behind it. So at Ziegler, we'll end up doing $1.25 billion of not-for-profit public debt. And then another major
senior housing,
senior not-for-profit senior housing.
Yeah.
We'll do another $250 million of FHA-related debt on the for-profit side. But on our not-for-profit side, we'll probably do 750, somewhere between $500,000 and $1 billion, probably 750 million of bank-related activity that's not showing up as public debt. So essentially, $2 billion of senior living activity this year, which is about half of the market.
And what's your forecast for your not-for-profit senior housing tax-exempt debt for 2013?
Should
be
be
a big pipeline.
Big pipeline, should be about the same. Interest rates are exceptionally attractive, so a lot of these providers, and again, many of them are multi-facility with large portfolios, have been replacing or reducing their variable rate exposure with fixed rate debt that ranges from right now 4.25% if you're in the A category, average rate, up to 6% if you're a moderate unrated, but let's just call it with an average of 5% for the whole industry. That's phenomenally attractive to eliminate the risk associated with variable rate debt or with the risk of the bank market, future regulation, and possible downgrade of banks. Now, for our bank friends out there, we work with dozens of banks around the country, and they continue to get up to speed on the sector. So there's plenty of opportunity for them. But prior to this fixed rate movement, I'd say the industry probably had, say, 60% fixed and 40% bank if you looked across the whole not-for-profit industry. And in this fixed rate wave, it's probably shifted to 75-25.
Well, I think the low rates are definitely helping stability and capital costs for the not-for-profit world. And good luck in 2013, and hopefully we'll see a lot of successful projects.
Great. Thanks, Steve.
All right, thanks for sitting with me.